When I first heard the idea that at some points in the business cycle, bad news is actually good news, as in bad news for the economy is good news for the stock market, I thought it was ridiculous. I mean, come on. How could something that's good for so many people hurt stocks or vice versa? Yet it's true. Good news can send us down. Like today, where the Dow lost 195 points, S&P shed 0.09%, NASDAQ actually inched up 0.13%. How is this possible? Because the Federal Reserve needs to manage the economy. When they see it overheating, the good news, causing inflation, they butcher us with rate hikes. When they see things have gotten worse, the butchery shops they turn into, they become delicious bakeries. Stocks can rise again. Yes, when the bad news comes, it's time to buy. But what exactly does the Fed consider good or bad? That's the big mystery. How do they decide when and where to bring the pain?
The house of pain.
Honestly, it's more complex than most of the professionals will ever admit on air, which is why we need to explain it to you so you can make the best decisions about your own money and your own portfolio. Let's start with what's good for the real world and bad for the Fed. First, our central bank doesn't want to see prices of goods rise more than a couple of percent. Why? Well, pretty simple. Regular people can't make ends meet if these prices are going up faster than their wages, right? There are a whole bunch of numbers the government puts out that measure personal consumption expenditures, consumer price inflation, wages, overall employment, like the Labor Department's all-important non-farm payroll report tomorrow. When they see inflation raging, meaning higher costs everywhere, then the Fed has to act. They can't do nothing. But the way they act, they raise interest rates. Now, that's bad for most businesses and their stocks, although some sectors can do just fine while others do get wrecked. Now, about 58% of Americans do have some exposure to the stock market. Sadly, many of them, though, have big speculative positions that have been hammered this year. Witness that Tesla makes up 10% of the average retail investor's portfolio. That's probably a mistake. Well, I mean, it was great when it was going up. Still, while a lot of people have some stock exposure, most of the market's in the hands of the super wealthy, not the wealthy, the super wealthy. So there's no need for the Fed to consider the fate of individual stocks. Sure, money managers care, but that's not a major constituency. Most people who own stocks do so via index funds. As the Fed sees it, the only people who really get hurt when they lower the boom on the market are those who borrow money to buy stock, or those who are rich enough to have huge positions. These are what I call real unsympathetic plaintiffs.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.